Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and of course one of the founding partners of the Dividend Kings. And this will be part 4 of a 4-part series that I did where I actually went and screened utilizing Joel Greenblatt's Magic Formula website, and I screened for stocks that were designed to beat the market. If anyone who knows about Joel Greenblatt and his little book that beats the market knows that his objective was to beat the market. And that's, of course, a very common objective. A lot of people are all about, investing the market. You get a lot of criticism, for example, of active managers who, quote unquote, don't beat the market. But I'm a believer in investing for investment objective. And sometimes it's not even prudent to try to beat the market. And I think we're in one of those situations today, as I'll explain later. However, having said that, I do believe that there are ways that I can outproduce the market, for example, by generating more dividend income than the market's capable of generating. And so when I went through this screen of 30 stocks, I ended up rejecting 17 of them. And I came up with 13 that were actually dividend growth stocks, and were 13 that were actually on our Dividend Kings master list or top buys list for that matter. So I ended up with 13 stocks that met my criteria, personal criteria as Mr. Valuation, as stocks that, had good dividend records, they were reasonably valued, and they had potential to continue growing their dividend going into the future. And so let's start by taking a look at those first 13 stocks that I screened for. And this is the whole list, not the first, but this is the whole list of 13 stocks. Now, what I want to point out here is these are all very high quality companies. They're all A-rated or better, with the exception of Verizon, which is BBB+, and then of course AbbVie, which is BBB+. But I do want you to understand that those are all investment grade. So I've covered 8 of these 13, and now in this video I'm going to be covering the last 5 here. And of course those are Comcast, Intel, Johnson & Johnson, Lockheed Martin, and Oracle. So that's what this video is going to be all about. Now, I'm also going to be looking at the S&P 500. So let me start with that because, as far as beating the market, what I pointed out a few moments ago, beating the market is easy when you come into a situation where the market is as overvalued as it is today. Now, this is the normal PE of 15. The orange line is a PE of 15, which you can see the market traded at that coming out, since 2010. And then this other blue line here is a PE of 16.9. And you can see that was a reasonable raise. Now, if I go broader, if I look at even longer term, I still have my orange line of PE of 15. And you can see the market trades within those two lines. Now my blue PE is 17.55. But the point is, these are references. These are things that I measure with. And you can see that the current valuation of the market is significantly outside of those lines, just like it was back here. And, we are expecting we had a down year in the 2000 recession. We had a couple of down years in the 2008 recession. We've got a COVID down year facing us, but we are looking to see some above average growth going forward. But the point is, coming out of the Great Recession, it was very, very difficult to beat the market because the market was actually, for the first time in years, undervalued during that time frame. Let me shorten this just a little bit. So this was some golden years, a golden decade, if you will, for the market. Partially because we had above average growth. I'll even shorten that one more year, get rid of the negative year. The market's averaged over 9% growth. It typically grows at 6 or 7. So we've had that going for us. We had reasonable valuation in the beginning, and now ending valuation that's very, very high. So this was a very, very difficult time with which to try to beat the market. So let's look at some of the 5 stocks that I'm going to be featuring here and how they compare. The first one I want to show is Comcast, and you can see that Comcast was very undervalued at the end of 2009, the beginning of 2010. Because of COVID, which we brought a down year, it looks a little overvalued currently. But if you believe the market's forward-looking, then, if you start looking at these forward earnings, there's probably decent value in Comcast here. If I look at its historical performance, and this again is from December 29th of 2000 to current, or to yesterday's close, a couple of things I want to point out. One is we've got very excellent dividend growth of 19.3% on average, 18.9% on compound average growth. We've produced slightly less than the S&P in terms of total income, but we also outperformed the S&P in terms of capital appreciation and total rate of return, and that really, I think, can be attributed to the growth rate that we saw with Comcast. Now, if I lengthen this one more year, I get a little slightly different performance. We now outproduce the S&P on dividend income, and we also outproduce it on capital appreciation. I want to remind you, these are extraordinarily high numbers for the S&P 500 in its typical valuation and typical performance over a decade. So Comcast looks like a very attractive investment. It's got, over a 2% dividend yield. It's A-rated with 54% debt. The next example here is Intel. And Intel is a slightly different story. I want to make sure you see what I'm seeing here. First of all, we've got the 15 PE. Intel is a moderately cyclical tech stock, but it has grown at over 13% a year. Now, that's extraordinary. The company's A-plus rated with only 29% debt, so we've got a good balance sheet. We've got a low level of debt. We have some flat earnings going on, which has brought the valuation low. But I also want you to notice that since the Great Recession, Mr. Market has been applying what I'll call a discounted valuation relative to the normal 15 PE that Intel has traded at several times and should and could trade at in the future. So if we just got PE expansion on Intel, we could have some really nice rates of return going out here, even, in spite of the fact that we don't expect a lot of growth, not until 2022 anyway. But the stock has an earnings yield of 9.6%, dividend yield of 2.6%, and I believe it's very, very attractive here. So I think this is one that we could be looking at. The next one, of course, is the indomitable Johnson & Johnson, AAA rated, one of only two companies, Microsoft being the other. You can see it's been a very consistent performer. We are having the first down year since I've been following Johnson & Johnson, actually. If you look at it going all the way back to 2001, take the price off the graph, you can see that the company's had really impeccable operating performance. We are expecting a down year as a result of COVID, but it's moderately down. Then we're expecting a nice recovery. But the point I want to make is I consider Johnson & Johnson just fully valued to moderately overvalued here. So I'm long Johnson & Johnson. And you can also see by looking at this graph, you want to buy the stocks when the valuations are low. Those are optimum times, especially when you got consistent growth ahead of you. Johnson & Johnson's earnings yield is a little skinny at 5.4%. Dividend yield is nice at 2.7%. It's AAA rated with only 26% debt. My only argument here is that I would be looking at, waiting for a slightly better entry point before I actually invested in Johnson & Johnson. From a standpoint of performance and dividend income, dramatically outperformed the market on dividend income, pretty much produced a dead heat with the market on capital appreciation, but the total return also was a dead heat, maybe just slight advantage to J&J. But again, it's moderately overvalued. The market's dramatically overvalued right now. The next one's another one that I think is a little skinny on earnings yield. That's Lockheed Martin. I've recently written about Lockheed Martin. I really like the stock. Again, you can see that there was a period coming out of the recession where the market was valuing it at a very low PE in the 9 and 10 range. And then, we start to see some resurgence and growth. I do want you to notice there's been virtually no impact from COVID. Actually, the stock's growth has accelerated here in the last couple of years. If I look at forecast growth, the company is expected to grow at 10% this fiscal year, 11% next, and then followed by 8%. The long-term trend line growth is expected to be just under 8%. So I think Lockheed Martin is a very attractive investment. The only thing I would like to do is see it just slightly cheaper. I'd like to see the earnings yield, above 6.5% to 7%. But you could buy it today, I think, and do okay. So Lockheed Martin is certainly attractive. 2.5% dividend, current dividend yield is A- rated, does have a little bit of debt. Oracle is a very attractively valued tech stock here, I believe. The company's earnings yield is 6.8. That's just slightly, higher than my threshold. The company's yielding a little less than the market right now. It is A-rated better. It's been an 11% grower. It is forecast to grow at over 8% going forward. So I think, this would be an above average market beating company given that the market is overvalued. So I would like Oracle here, more for a total return opportunity than I would a current income opportunity. So there you have it. These are the final five stocks of the 13 that I looked at. And one of the things that I talked about here, when I talked about these companies, all 13 companies, I mentioned in the written portion, you could probably build a portfolio, a concentrated dividend growth portfolio here that would outproduce the S&P on terms of dividends. It would also have a potential to outperform the S&P from the standpoint of total rate of return, simply because we have such an overvalued situation. In other words, I don't think it's a fair fight for the market now. With the market's high valuation, odds are we're going to see weaker performance over the next decade than we did the last decade. Where these stocks are reasonably valued, we should see even equal or at least even possibly better performance over the next decade. Anyway, this has been Chuck Harville saying thanks for watching. Hope you enjoyed this video. If you like these videos, don't forget to ring the bell so you can be alerted to new ones. Subscribe to my YouTube channel if you want to see additional stuff. Of course, as Dividend King subscribers, you'll be getting my Fast Graph Friday video Friday. Anyway, I appreciate y'all. Everyone be safe. Have a great holiday weekend, and we'll talk to you again real soon.